Welcome to the download. I'm your host, Dave Richardson, and it's time for Jobs Report Friday with Canada's hardest working economist, Eric Lascelles, Chief Economist at RBC Global Asset Management. And Eric, I know I just got to state we're a little bit late with this. We were supposed to do this on Friday morning, but I was on vacation. I know you frown upon vacations
Mm.
because you're always working hard. And so you're a little bit. If Eric seems agitated today, he's agitated at me, not the beloved listeners of the podcast, because he wanted to get this done on Friday, and I delayed him. So I'll apologize up front, Eric, so as to calm you down a little bit before we get going.
Boy, am
But
I
how are
mad.
you doing?
No, I'm
You're
not
good?
mad. I'm just fine, thank you. Yeah, Dave, it's busy days, and so always tap dancing in one direction or another, but doing fine. Feel like we've got half a handle on what's going on, which is always nice.
Half a handle. Well, that's probably more than most because it continues to be a really interesting period, and that's a couple of bank people who love economics saying that economics and markets are interesting, but I'm gonna lay it out there that it is, and that most of the listeners find it very interesting because they're listening to a podcast about those subjects. So that would be a good thing. But why don't we start with the with the jobs reports, which have been, I guess, an area of uncertainty, and they've been a little bit weaker than reported. Although maybe we're not counting right and firing the people who count things and all that. So there's all that stuff
Right,
circling around it.
right.
But when the number was reported, we had the number in Canada as well, correct,
We did,
Eric,
we
on
did. It
Friday?
was week
So
two. Yeah,
so
that's
so
right.
so what do the U.S. and Canadian numbers look like from Friday, and what are your
Yeah.
thoughts on it?
Gosh, I mean, quite soft on both sides. A
Yeah.
little bit of context is appropriate. I'll get to that in a moment, but why don't we get the headlines out of the way to start with? So, U.S. payrolls, this is the data for August. Of course, it's released in September, but the data for August, just 22,000 new jobs in the U.S. in August. And so that's a pretty small number. The consensus had been 75,000. And, if we'd rewound a year or two, we might have defined normal as 150,000 or something. So
Yeah.
22,000 was not very many. I guess that was the big takeaway. The other big takeaway, and it was really just a symbolic sort of thing, was that as they did the standard revisions to the prior 2 months, the June numbers, which is going, several months back now, but nevertheless, those June numbers flipped from a positive to a negative. So minus
Negative.
13,000, the
Yes.
loss of 13,000 net jobs in June. That is, for what it's worth, the first negative month since December 2020. So not the norm, and so quite unpleasant on that front as well. And of course, I guess just job numbers always attract a great deal of attention. There's a reason that we anchor this podcast to them.
Yes.
They do
Yes.
matter a
Yes.
lot, but of course they've taken on an outsized interest, at least because a month ago, and you've sort of alluded to a bit of this, but a month ago there were also quite weak numbers and big negative revisions, and of course the head of the BLS, the Bureau of Labor Statistics, was fired arguably
Yeah.
because the
Yes.
numbers were dissatisfactory, and so they are again dissatisfactory, I guess, is the takeaway here. I still think the numbers are credible. I mean, I think we know there's a high
Yeah.
level of volatility to them and uncertainty associated, and we know the BLS is underfunded in a way that is literally reducing the amount of data collection they do, and we know that you and I and everybody else don't answer their phones anymore, and that makes it hard. And so, like, any number of things are making the data a bit harder to trust, but I
Yeah.
don't think that there's an explicit bias in it. I mean, we're on our toes in case that were to happen, but I don't think that's part of the conversation this time. Now, couple ways we can go from here. I mean, it was certainly weak in other regards. I mean, one would be, and this is a longer term trend, but one kind of neat thing we've done recently is we've broken down U.S. hiring into cyclical versus non-cyclical sectors. So we've done this
Okay.
mathematically. I mean, certainly government tends to be non-cyclical, and you can imagine the sort of cyclical sectors, but we actually did it inspecting the data, saying, oh, that's surprisingly stable. And so some private
Yeah.
sector industries are considered non-cyclical by that definition. But when you do that, Dave, and this is year over year-over-year data, what you find is that there has been no net hiring in cyclical sectors over the last year. In fact, for the last
Wow.
year and a half or so, it's been pretty much flat. And so the hiring has come from the non-cyclical side, which is perfectly fine. And indeed, this month's data showed quite a bit of hiring in healthcare, as an example, and those could be
Yeah.
wonderful
Yeah.
jobs. But equally, it's not telling you what's happening in the economy exactly, right? I mean, these are sort of secondary things, and so it would suggest there is some degree of real caution among, I can't say private sector because some private sectors aren't that cyclical, but nevertheless, in the traditional cyclical sectors, they're behaving quite cautiously. It's not brand new, though. I mean, of course, the rate of hiring has slowed, but actually over the last year or so, there hasn't been a whole lot. So this is not a brand new trend, but it is one that is softening to some extent. So it just speaks to the, an even softer underbelly to the job numbers. If you wanted to get a proper perspective, though, you do need to factor in the fact that there's not much population growth in the U.S. right
Yeah.
now. I
Yeah.
mean, the immigration has really dried up. Some of that was happening a year ago as well, just as illegal immigration was slowing, I think, from memory,
Sure.
from late 2023 even. But nevertheless, of course, that's accelerated. There's even less immigration and certainly even less undocumented immigration. And so what a normal rate of hiring is lower. So for instance, and I think we've
Yeah.
given you kind of different numbers every month, but my latest figure I'm hanging my hat on is, maybe 50,000 jobs a month might be normal right now. Whereas,
Yeah.
as I mentioned, maybe 150,000 was normal per month a couple years ago. So, 22,000 jobs, not that big a miss. It is still a miss, though. And on a trend basis, we are accumulating a number of misses here. And,
Yeah.
of course, you can cut right through all of that messiness and stop trying to figure out exactly what the population is, just looking at the unemployment rate. And the unemployment rate has gone up. It's not bad. It's gone from 4.2 to 4.3%, but it certainly is higher than it was in the mid threes a few years ago, and it
Yeah.
is again seemingly trending pretty clearly higher, and it's the highest since 2021. So. Net, it was a soft report. I think when you combine that with the Jackson Hole speech by Fed Chair Powell, it does argue pretty strongly for a Fed rate cut. And I've ignored Canada for the moment. We'll get to that, I'm sure, in a moment.
Yeah, yeah, and just come in with a couple things on when we talk about some of these questions about the data
Mm-hmm.
and the reliability of the data, which led to that firing. If you stretch it out now over several months instead of just looking, and we've talked about this a lot over the years as we've done these Friday jobs reports podcasts is that the number's important. You want to look at the number and get the number that comes out like as it did last Friday, but you and look at the revisions. But what you really want to do is take a step back and take a look at a longer term picture, and you're whatever's happening, you're very clearly seeing a trend where those numbers are coming down. Now you can look as you have dug into probably on your vacation and see what's behind those numbers, why those are there any other reasons why the trends are happening. And as you mentioned, reduced immigration in the US, and when we get to Canada, we've got to think about reduced immigration in Canada as well when we look at the Canadian numbers. But nevertheless, no matter what way you slice it, the job market is not as robust as it was a year ago or 2 years ago. And that has implications, which you then link to what the central bank does. And of course, there's been a lot of talk in the news and coming from many different directions on the need or no need for the Fed to act. And it looks more and more as these numbers continue to be soft, as you said, that the Fed is going to ultimately now reduce rates. And the question now becomes, have the numbers gotten weak enough to not just reduce by 0.25%, but maybe even go to 0.5% when they meet in a couple of weeks?
Yeah, I think that's exactly it. So the debate is now how much cutting, not do they cut, and not to be too unexciting here, but it looks like a standard vanilla 25 basis point cut is still thought to be the most likely. I was checking out market pricing just before this. It's maybe a 10 or 15% chance of a 50 basis point cut is the way the market is currently thinking. Now, let's see what the next inflation number brings, and maybe that'll change the equation again. But very clearly, the labor market is cooling. The Fed at Jackson Hole did indicate that they believe inflation from tariffs to be temporary. I think got to avoid that transitory word. It's got a little bit of a taint associated with it these days, but nevertheless, so transitory there. They said quite correctly, this is before the job numbers came out, that they viewed there as being some downside risk to employment, and so that has happened. And so again, that's why the market is quite confident there's a rate cut coming. Keep in mind, as much as the White House is trying to gain influence over the Fed and Fed voters, and you can argue there are two voters that are already linked to the White House, and that number will rise. Of course, that isn't the case right now. It is still Fed Chair Powell as chair, as well as that might be a pushback against a 50 basis point cut. I think what the market has done, though, Dave, is priced in pretty confidently that September 17th cut, also priced in the great majority of an October cut, also priced in at
Yes.
this point the great
Yes.
majority of a December cut, and
That's
actually is
right.
up to almost 6 rate cuts over the next year. So
Yeah.
not shy about looking for rate cuts, and that's a combination of, hey, the economy might have some weakness, and similarly, hey, there might be a political wind here that encourages a little bit more easing as well. And I'm sympathetic to both of those forces right now.
Yeah, yeah, and I was out talking to some advisors and investors over the last couple of weeks, and talking about, if you go back to last September, when the Fed did cut rates for the first time in this rate cutting cycle, and cut rates by the Fed funds rate by 50 basis points, a half of 1% last September, you saw the longer term rates. So if you look at the 10-year US Treasury, it popped higher, right? Whereas this time, and that might have been the, is it the right thing to cut rates? And if we cut rates too soon, does that create inflation longer term? So those longer term rates go up. This time, the Jackson Hole speech occurs. He says, yeah, maybe there's some room for rate cuts. Now we're moving closer and closer to where it's almost certain that we're going to see a rate cut. And those long-term rates have stayed pretty stable, which is another one of those indications that the economy maybe is a little bit softer than we want it to be right now.
Yeah, I think that's quite right. I mean, there's so many things happening at the long end of the curve. I mean, we were just talking before this podcast that 10-year yields have been declining, and of course that is a statement, I think, of economic concern, and we're seeing some weakness here and a bit of a risk aversion push and so on. You go further out the curve to the 30 years, and you see again some decline recently, but nevertheless, yield curve that's much steeper than we're used to, and
Yep.
30-year yields that have been, despite declining recently, relatively resistant to the declining trend that you might have expected, given a non-trivial amount of rate cutting
Yep.
already and a certain amount priced for the future. And so that would seem to reflect, interestingly, not really inflation fears. Often that'll show up in long-term yields, a little tiny bit, but that's not the main reason. Main reason is just, the other bit, which is just is a bigger term premium, it's a bigger risk premium. There's seemingly less confidence in the fiscal positions of
Yep.
countries. And indeed, as we're recording this, I think the French Prime Minister's vote just failed, and so there's going to be a shift there. That was over austerity that the public doesn't want, but is arguably necessary. UK is struggling with this. Japan's Prime Minister just resigned yesterday, and that was at least in part over some of the painful measures there as well. And so there is unfortunately a fair amount of fiscal austerity that's necessary across a pretty broad swath of countries. They're not totally embracing that, or their voters or their or their parliaments are not totally allowing that to happen. And so I would guess that it's still going to be a pretty steep yield curve kind of environment, and these longer term yields, certainly while ebbing and flowing, might still be somewhat resistant to the kind of happy downward action you might normally see if you had the Fed queued up for 3 consecutive rate cuts, which seems to be the case right now.
Yeah, and when we had Stu Kedwell on a week and a half ago, talking about the stocks that benefit from a steeper rate curve, he covered that off because that pretty much looks like where we're going. So, okay, so we've got all that political instability everywhere. Come back
Mm-hmm.
to good old solid calm Canada.
Right.
And how is our jobs report, and what are you seeing coming out of
Yeah, not
that in terms of the Canadian economy?
Not so solid or calm, unfortunately. So,
Yeah.
I mean, 65,000 jobs lost, so not a laughing matter whatsoever. Pretty steep
Yeah.
decline.
Yeah.
Prior month was down 41,000 jobs, so that's 100,000 some in the last 2 months. Now, you and I both know the Canadian job numbers are pretty choppy. You probably want to smooth things out a
Yeah.
little bit. The month before that had been a big positive, so let's do that. I would say, even taking a 3 month moving average, it's pretty clear we're in at least slight negative territory. There are some
Yeah.
genuine job losses happening here. Not that you should feel too good about those, but if you wanted to temper your concern, you might note that quite rightly that in this month at least, it was mostly part-time job losses and it was mostly
Yes.
self-employed job losses. Those tend to be lower quality jobs, such that the net hit to the economy or Canada's income earning capacity maybe didn't quite suffer as much as 65,000 lost jobs would suggest. But still, there is a weaker trend here for sure. You mentioned earlier that, of course, Canada doesn't have any population growth either right now by virtue of
Yeah.
this
Yeah.
immigration target shift. And that's not a permanent condition because the target is actually a non-trivial number of permanent residents coming in. But just as the prior cohort of temporary residents leaves, there is just a air pocket here where there's not
Yeah.
any population growth. And so, again, normal might be a flat number. And so we're running a little bit below that, but not scandalously below. And then just like with the US, you sort of turn and say, well, maybe at the end of the day, the unemployment rate's a thing I need to look at here, and it'll give me a sense for whether there's slack and whether it's getting worse or getting better, and it just helps to control for population swings versus job swings. And so, unfortunately, as with the US rising, so unemployment up to 7.1%, it's the highest since 2021. And it's been I can't say a steady rise because we had a couple months of decline in there over the summer, but nevertheless, it's a pretty visible rise. And as much as a normal unemployment rate in Canada is probably a couple percentage points higher than the US, I'm afraid to say, nevertheless, this is now a good percentage point plus above what we might deem to be normal. And so it's not a brand new situation. We've known Canada's had some slack for a while, but the slack is opening up more. And to be honest, it's more than a bit disappointing because the reality of tariffs, which would seem to be one of the bigger forces here, has been that the tariffs have actually hit Canada a little bit less hard, or at least the theoretical
Yeah.
impact has been a bit
Yeah.
smaller because all that USMCA compliant product getting exempted, and we're now in a position where about 90% of what Canada sells to the US is being exempted, and so you would think the blow wouldn't be that hard, but the reality is we're seeing job losses. It doesn't seem to be. We thought maybe, gosh, initially there was such apocalyptic fear, and then the reality wasn't as bad. Maybe there's a bounce back or something later in
Bounce
the
back. Yeah.
summer. We're really not seeing a bounce back here. Indeed, and I probably talk about GDP numbers less than you would think I should, since it is the final benchmark of how things are
Yeah.
going. But the problem is they come out so late, and they get
Yeah.
revised, and you just not really the way to stay get the pulse of the economy in real time. But nevertheless, not a bad framing mechanism in retrospect. And so, unfortunately, Canadian Q2 GDP came out negative, so declined
Yeah.
1.6% annualized. That wasn't a great shock, but it was a little worse than we'd all thought. And then, Q3 is still an open question. I mean, we don't even finish the quarter until the end of this month, so let's not get ahead of ourselves. But just given a fairly sour handoff from the second quarter, given that we do have a flash estimate for July, which is the first of the 3 months that constitute the quarter, you'd need a pretty good looking rebound in August and September, which again, we just saw job losses in August, so
Yeah.
not exactly
Yeah.
counting on this. You'd need a pretty good rebound not to have the third quarter come in negative as well. And so,
Yeah.
and people like to call recessions 2 quarters in a row. I push back against that. I think it's a bit more nuanced and so on, but certainly some real economic weakness and some real pain being felt.
Yeah, and I was just going to jump in and say, I think if you know anyone who's looking for work, or particularly, again, I've talked about many times in the podcast, I've got a 21 and 18-year-old, and the job market certainly was not what it was 2, 3 years ago. To get summer employment, and talking to their friends, but again, just people who have lost jobs and are looking, and I bumped into some of them along the way as I'm out and about, and it is not an easy job market right now, and that is reflected in this. So that's your anecdotal on top of then the numbers actually come, and that's when the economist nods his head and goes, "Wow, this doesn't look good." Now, despite and that is despite though our interest rates. We talk about the Fed cutting rates and maybe cutting rates significantly here. We're already well below the U.S. in terms of our bank rate here in Canada, and across the yield curve. although the yield curve is steepened, our rates, our longer term rates, are significantly lower than the U.S. So, what does it take to get this Canadian economy going again?
Yeah, I mean, I would say I don't know if I have an answer to that last bit, but I will say
Yeah, yeah,
policymakers are doing a reasonably credible job in Canada, and so Bank of Canada was ahead of the game in cutting. It looks like it was appropriate given the damage we've seen since. Looks like some more is probably coming. Markets priced in most of a cut. It's kind of weird. Also for September 17th, it's rare those dates line up, the Fed
yeah,
and the
yeah,
Bank of
yeah.
Canada. But get ready for big day. And so looks like there'll be some more help, but Bank of Canada cannot be said that it's not already trying. And then similarly on the fiscal side, I mean, this certainly new government is proposing a fair amount of spending and has done a bit of tax cutting and infrastructure and the like. And so we'll see how quickly some of that money gets out the door. But we and most are budgeting for some positive fiscal impulse there too. So there are some helping hands, seemingly not enough yet. We are right now assuming that there are a couple more challenging quarters, shall we say, for Canada, and then there may be scope for some tentative acceleration in 2026. And so that's what we're looking and hoping for. But I have to confess, over the last 4 or 5 months, we've been more than a little disappointed with the data that's come out, and it's even been a little hard to reconcile versus the actual, impediments and sand in the gears and so on that tariffs have thrown in, because it hasn't been as much as we thought. Maybe it speaks just to the high uncertainty does damage of its own, and
That's right.
everyone's sitting on their hands. And it seems pretty credible when you think about it.
That's exactly it. It's not. It's the uncertainty itself, not the actual policy, that creates the problem. I think you even said it on one of the earlier podcasts this year when we talked about the tariffs. That hey, just give us the bad news and then
Mhm.
stick with it, and then it's resolved, and we know what we're dealing with. But again, as you talk to business owners, I know you talk to business owners, I talk to business owners, and you're just sitting there like, what do I do? And maybe it's a little clearer, and it looks like it's going, as you say, it's I think we can be fairly optimistic that it's going to turn out quite a bit better than the worst case, but it's still sitting there in the background, and you still have to try and figure it out from a business perspective. And again, large corporations have different ways that they can work through it, but small businesses, and they're the major employer in the country, it's harder for them.
That's absolutely right. Yep, yep. Right now, we have a sense, perhaps, but of course, in Canada's case, that USMCA trade deal, does it survive? Does it not? I think you'd have to assume it does. If they were going to scrap that thing, it would have been scrapped months ago, in theory. But what sort of concessions are demanded to keep it, and what exemptions are put in place, if any? And so, yep, still enough uncertainty, unfortunately. And so, I guess that's where the damage is.
So how much more can the Bank of Canada lower rates, given that we're significantly lower already than the
Right.
U.S.?
Yeah, I mean it's interesting. We think not that we're wildly off consensus by any means, but we think maybe a little more cutting than the market assumes. In fact, I would say I struggle a little bit to understand why the market says, okay, the overnight rate's 2 and 3/4. The market doesn't even have two rate cuts priced in over the next year. And so it seems to me like if you have an economy that's shrinking and inflation that's really not too far off the mark, and tariffs shouldn't be too inflationary, particularly as Canada's retaliatory tariffs are taken off. That was meant to be that would have been the channel by which you get more inflation. And it's not quite clear what a neutral rate is in Canada, but call it 2 and 3/4. And so even cutting down to the low twos is hardly a huge jamming on the accelerator kind of moment. And so historically you would have been maybe nervous that the housing market would go into overdrive, but it's pretty
Yeah,
soft right now, right? Like home prices are
yeah, very much so.
falling and condos are
Yeah,
very weak, and so seems to me like you could do more. And so again, the challenge here is once upon a time, the first hint of trouble, rates plunged to 0 or zero point 0.5 or something. I think there, some lessons have been learned such that we're probably not going to see that kind of extreme action. But and I can't say this is our base case forecast, but I don't see why you can't get into the ones if you needed to. I mean,
yeah,
that feels okay to me. And so as a scenario, at least we could have a fair bit more cutting in front of us if it's needed.
yeah, and it just seems, the Canadian economy, it's run at a slower pace than the US for such a long time. And generally, when you have that happen, and you've talked about this before, you generally see things, the Canadian economy catch up at some point. And it just hasn't happened even with the lower rates.
Yeah, I know that that's quite true, and I mean, that there's a long-term 40-year story of that. There's a
Yeah.
shorter-term 2-year story. There's a even shorter-term 6-month story, and they all kind of point in the same direction, which is, yeah,
Yeah.
Canadian economy has not been moving. We're certainly hopeful that productivity, which you'll recall was falling for a period of time, that it can start rising again, and we got a little bit of that, and some of it's just this mechanical population goes down and productivity goes up sort of
Yeah.
thing. But actually, quite disappointingly, the Q2 numbers came out and productivity fell. Now, of course, when the economy's falling, I guess not too many things are pointing in the other direction. But nevertheless, still waiting. I'm afraid to say on that important term, because that's the ultimate measure of well-being.
Yeah, and then I think a lot of people might look and go, well, hey, the Canadian stock market is at an all-time high, and the stock market's looking forward and in some ways projecting where things are going to be, but the nature of the Canadian stock market is such that it's a lot of financial services companies that love a steep yield curve
Mm-hmm.
and lower rates at the short end, and a lot of mining companies that love record gold and silver and platinum and all these metals that are moving. The
Mm-hmm.
price of oil isn't fantastic, but the Canadian energy industry is so efficient in terms of having lowered their costs over the years that they can still make money at these levels. So you can't really just look at the Canadian stock market as a sign that things are gonna get better. If I'm looking at the S&P 500, I'm seeing it sitting at a high. I go, oh, that's it's probably an indication that rates are probably lower a year from now, and profits are probably higher, and economic growth is pretty solid. But you can't make the same association in Canada.
Yeah, no, that's quite true. Yep, it's an interesting market in terms of the skews and tilts that it has. Though I must say, not to undermine your final comment, of course, the U.S. market has gotten awfully interesting too, and these big tech companies are taking such a big share that suddenly, it's not just about the economy. You need to have a tech view, much as in Canada, you've always had to have the oil and the gold and the banking sector view. And so, gee, whether that's ideal or not, I guess that's an open question. It does, I'm sad to say, make my job a little bit less important, though, to the extent that markets can diverge from the economy quite significantly these days for quite sustained periods of time.
So Eric, let's just finish off on inflation, because we're getting I guess the CPI and PPI out of the U.S. this week. So consumer price index, producer price index. But we've had some numbers come out around inflation. Oh, since we last spoke, are you getting any more sense of the direction of inflation? Is it still anchored where you like to see it in terms of where we need to get it back to?
Yeah, I mean, I guess no was the answer to that last bit, but that's been true right through even before the
Yeah,
tariffs came on. We just didn't quite get back to the 2% number that we all hoped that we would. So, there is a bit of a sticky, maybe scarring issue, you might say, from the post-pandemic inflation spike, and it's clear that we are getting some effects from tariffs. So this is mostly a U.S. conversation. The other countries aren't
sure,
aren't seeing,
sure.
nor should they expect to see too much extra inflation, just given the way currencies have moved and given the lack of retaliation. But for the U.S., I mean, we're definitely seeing it in the sense that we can look at core goods inflation. It's higher than it was. We can look at particular products and toys and games and appliances and things like this, and they're definitely moving faster, which is consistent, particularly with Chinese products coming into the U.S. at a pretty hefty tariff rate. So we're seeing it, and I guess I would say on the aggregate, you can see, and the consensus for this week is inflation that's a little warmer than normal. Again, 0.3 is for headline and core month over month, and so a little hotter. But I must say, inflation has had some helping hands here. And so, for instance, in the U.S. context, lower oil has been enormously
Yeah,
helpful.
yeah.
Soft housing market, and keep in mind the lags associated mean that even though maybe it's not quite as soft as it was a year or two ago, that's still bleeding through the lags and people resetting mortgage rates and rental rates and things. And so those are really helping to keep inflation down, even as we do see some goods components go faster. The other thing that's maybe tempering the inflation somewhat, we'll see how long this lasts, is that we are seeing foreign manufacturers actually eat a little bit of the price increase. So we've seen like import prices fall, which means that foreign companies are And then here and there you hear, American firms eating a little bit too. I really not a lot on the aggregate, but it does seem like the car makers at least are definitely taking kind of multi-billion-dollar hits as they hold their prices back. So it's not quite all accruing to the consumer, and so we still walk away saying we do think inflation is going to be somewhat higher over the next 6 months to 9 months, and we're still budgeting for headline numbers in the mid threes. And do note the forecast just later this week is a 2.9 already, so rising from a 2.7. So we are trudging in that direction. But it is worth keeping in mind it's nothing like the order of magnitude from the pandemic, right? That was 9% inflation. This might be 3.5% kind of inflation, and we are getting a little lucky with some helping hands here, in a way that maybe prevents it from getting too high. And in theory, this was always true, but this is a one-time price level shock, and so in theory, central banks are meant to be able to maybe not quite completely look through it, but downplay it to some extent. And of course, the
Hmm.
nervousness is might household expectations shift, and might that become self-fulfilling, and we really don't know yet. But in theory, it shouldn't have to. And so this is why central banks are able to cut despite the extra
Well,
inflation.
and just as you're talking through all those sort of those areas that you described as kind of good fortune,
Hmm.
that is all part of the Trump strategy, the Trump economic team strategy, which is okay. Well, we're going to get oil prices down, we're going to reduce housing costs, and that's going to be the offset for the tariffs in some way. That's the only way you get back to a normalized inflation. But you can see even with those, I guess the opposite of tail, it wouldn't be tailwinds, but with all of those things falling into place, you still don't have inflation really back down to the levels that you want to
Hmm.
get at. So clearly this policy prescription is likely not going to get you back to a 2% inflation anytime soon.
Right, right. I guess the X factor is how much economic damage does the U.S. feel, and that can do its own deflationary kind of force.
Yep.
But yeah, I have to confess we're not right back to a 2.0 happy inflation number in our forecast horizon. And really ever since the pandemic, or at least the post-pandemic recovery, which was so wild, we've been of the view that yep, I'd take the over, not the under, on a 2% inflation target, and we are probably going to run a little warmer than that. And that has been the experience so far.
Excellent. Well, Eric, that's a terrific update. Sorry that I delayed it. I know you were chomping at the bit to get to this last Friday morning. So once again, I'll it's my fault, beloved listeners of the podcast, not Eric's, because he's always working away. But a great overview of the and we haven't. And I think the one thing I would say as we start to move forward is maybe we'll spend a little bit more time on Canada than we spent the last few months, because it looks like it deserves our attention. Obviously, it's where we live, but it deserves our attention in terms of just how weak the economy may be right now.
Mhm.
And let's try and figure out how we're digging out of this. So, anyways, thanks, Eric, and we'll catch up with you in a couple of weeks.
My pleasure. Thanks. Bye, everybody.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.